Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of it should be relied upon as any form of advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. I want to really look at the moment, the way that we are evaluating central banks. We have every right and every reason to question them. They have not exactly handled themselves all that well over the last decade. There have certainly been lessons that might not have been learnt, and we possibly are still doing them now. But you do have to probably look at it from the point of view and take what they're saying as the most likely outcomes, because in the end, they're the ones that control that. And what I want to talk about is the moment, the reflation trade we've been discussing for the last couple of weeks. We've really started to see the bond market take off. There's even a suggestion that the bond vigilantes are back in terms of how we're seeing bond yields move, and it is quite similar to what we probably saw in the 90s and in the early 80s. And if you look back at 2013, there's even people relying on the idea that taper tantrum 2.0 is not only happening, it's going to happen sometime in the interim in terms of where we sit. What might have been lost in all of this, though, is the disjointedness that's going to come with getting out of the COVID world. And that, I think, is being seen at the moment in economics. If you look at things particularly like employment, the ADP numbers, the PMI subsectors that have employment, if you look at non-farm payrolls, they are reasonably good, but they're disjointed. And month to month, they are very disjointed in terms of where they sit, which is why Powell's comments, which were taken as absolutely negative in terms of what they could be doing, that basically the Fed said that it's not going to do any more. I don't take it as that. I think, again, the market's looking for what it wants to look for rather than actually listening to what he's saying. They're going to be patient. They're not going to step in yet. They could if they need to. There's going to be a lot of disjointedness. And then the key point that I think we're also forgetting is that take COVID out of all of this. Before this all happened, we were in a low inflation environment, and that isn't changing. And that employment figure is where that comes back to, because without employment soaking up the slack that's there in the market, wages aren't going to move. So inflation might be a transitory event rather than a structural event. And that's, I think, what's also slightly lost in this discussion. But from an FX point of view, at the moment, it is all around the US dollar. There is clear risk off movement across most things. But if you look at something like the Swiss franc, or if you look at also the Japanese yen, it's not translating into them. It's just translating into a US dollar story. So going back to Powell and the differential that's happening in the bond market, it is pulling USDs back home. It's also meant, if you look at something like euro dollar, for instance, it dropped below 120. I put cable to one side because it's all around the UK budget and they're a bit different. But the one's really catching your attention has got to be dollar yen. Dollar yen, what an astounding move it's been. We're now at 8-month highs and going higher still. It's not hard to make that argument, considering that JGBs to US treasuries, the gap in them is huge, and therefore the spread is just such an attraction. It doesn't look like slowing down either, and that is also why in the interim you've got to keep watching those flows in the bond market. But just the reason I'm hesitant to say more than that, and probably looks outside of 7 to 10 day trading periods, is that in the end, that idea that we are getting out of COVID almost scot-free, I just cannot buy. And you can see it in the employment figures that we are going to have disjointed periods, that inflation isn't going to be this structural change and we're going to just take off to the moon and central banks are going to have to come back in. They are telling us that they'll be patient through those transitory periods. We need to be aware of that as traders. So although the USD long is probably the right call at the moment, it will switch just as fast as it did 2 or 3 weeks ago, and therefore be nimble, have your stops close, and keep looking for the momentum rather than anything outside that could actually be a contrarian trigger to go with, because as soon as you start doing that, you'll get caught and the momentum will run you over.